What a quarter it was for retail. Earnings reports and cautious guidance from giants like Walmart and Home Depot gave us a deeper look at just how things are going in the sector. Our team dove in to get a better gauge at the current health of retail, the strength of the consumer, and how e-commerce is changing it all.
Well, Walmart continues to gain among higher income consumers as they look to the retail giant for value amid inflation. This, as a new report by Kearney Consumer Institute, shows that the convergence of optionality, quality, and loyalty is blurring shopping behavior. Here to discuss is Katie Thomas, lead at Kearney Consumer Institute. Good to have you on the show, Katie. Now, we know that we hear this term trading down as a sort of general umbrella when it comes to what consumers are doing right now. But you say there's some things that get missed in really simplifying it to just trading down.
Exactly. And really the question for me, Rachelle, was do consumers see these trading down decisions as trading down? What they tell us is not really. Only 34% of the time do they think these trade-offs they make are actual downgrades in quality. And so it's exactly like Brooke was just talking about, is as a consumer, as you assess, am I going to cook at home? Am I going to go out to a restaurant? There's all these different options, but in reality, the consumer is really in the driver's seat. They feel empowered to make those trade-offs, and they can really think about, where do I want to spend my money and how is it going to be spent across the whole wallet, not just category by category.
So then to that point, then, what does that mean in terms of things like brand loyalty and what you can do once you lose a consumer to a different brand?
Well, that's the thing, it's the similar story there where it sort of goes back to the power is in the hands of the consumer right now. We talk a lot, with inflation and everything, that the consumer is almost a victim right now, but they feel a lot more empowered than we're actually talking about them. They're able to look across the whole wallet. 70% of consumers say, I'll cut back in one category in order to spend on another. And when that comes to brand switching, if they're experimenting, over half of the time they experiment with a new brand for whatever reason it may be, stock out, inflation, or just something that caught their eye on shelf or online. Over 50% of the time, they're not switching back. So as a brand, you really want to be thoughtful about continuing to evaluate your attributes and the value prop to the consumer to make sure you can either keep them or win them back.
Well, I thought something very interesting in here in that survey, talking about the perception on the quality of the trade-off and how it differed by context. And you gave the example of cooking a nice meal versus going out to eat. People willing to sort of upgrade when it came to that, but not so when it came to things like washing your hair at home. How important is the context, and what do retailers? How do they capitalize on these trends?
It is. The context is important. And I think, when you think about something like cooking at home versus eating out, that is a little bit of pandemic hangover in some ways, because we all got to be better cooks. We learned what cuts of meat we like. We started splurging on that nice bottle of wine or bottle of liquor. That's a category you're seeing consumers continue to invest in. It's really those two ends of the spectrum, that value end, that perceived value, and then the luxury end. So again, it kind of comes back to, we've been talking about the death of the middle since the beginning of the pandemic, which is if you're that sort of middle of the road brand without a clear value proposition to the consumer and a real reason to believe, that's actually where you're at the most risk, because we've seen luxury to continue to perform and value, discount, even dollar store continue to perform, because that's where consumers feel like they can get value in these inflationary times. So it's really that mid-tier that needs to make sure they're kind of hitting that price value equation for their consumers.
And I want to ask you about a trend that you're noticing. The latest influencer trend, you say, is actually de-influencing. Break that down for us, because there is some irony in that, and a trend that perhaps retailers should be keeping an eye on.
Well, and that influencers are de-influencing, but still influencers. So there's an interesting dynamic we're seeing continue to evolve. We did some research on the consumer and their relationship with influencers a few months ago. And 75% of consumers told us they don't trust influencers, but 64% said they'd taken recommendations from influencers to buy products. So we're really going through that evaluation of who they trust, who's actually authentic. Broad strokes, consumers are very wary of influencers, but most of us have one or two that we do rely on for functional product curation. So I think in some ways there's actually opportunity to move away from the trust in this bigger storyline and really focus on the function an influencer offers to a consumer. And that's the way for brands to think about it. And that's what kind of leads into this de-influencing, which is I felt like you were just paid to make me buy this product that ended up not performing.
So as we see customers obviously becoming more nuanced and a lot more discerning in their taste, though, I also want to talk about the way that they're spending, because we hear a lot about the strength of the consumer. But when you look at credit card debt, according to the New York Fed, saying that credit card balances increased by 61 billion to reach 986 billion in Q4, and that's surpassing pre-pandemic levels. So when we're trying to get a gauge of how healthy the consumer really is, how would you characterize them?
Yeah, it's tough. I think when evaluating optimism versus pessimism versus realism, I think I'm a realist. Yeah, similar to credit card debt, you're also seeing savings rates that are, 2-3% right now. In the pandemic, sometimes they've got as high as 20-30% with the stimulus checks. So consumers are certainly spending, but I do think we anticipated this bounce back from the pandemic. Again, Brooke talked about it with restaurants. There were a lot of assumptions made around certain pandemic behaviors continuing, for instance, in the tech market, whereas in fact, you're seeing this bounce back from consumers of wanting to just be out and engage again. So as the labor market stays competitive, as wages continue to grow, you're seeing Home Depot talk about investing in their frontline workers and in raising wages. That's still generally positive for the consumer, but I think they'll continue to really evaluate these trade-offs where they're really going to want to spend and splurge versus where they can not just save, but in certain areas cut out categories completely.
Well, if retailers the size of Walmart and Home Depot are issuing cautious forecasts for 2023, what does that imply for the health of retail more broadly? To help answer that question, we're joined by Deborah Weinswig, Coresight Research founder and CEO. Deb, thanks so much for being here. So really interesting results that we got this morning, and not a lot of enthusiasm, you could say, for 2023. What are you hearing and what are you seeing?
It's very interesting. We at Coresight really focus on the macro environment and how that impacts, these individual retailers. We did a survey about a week ago, and 82.3% of consumers are aware of, the inflation rate and higher prices. And so that definitely could be giving Home Depot and Walmart a bit of a pause in terms of thinking ahead to 23 or the rest of 23 as it relates to the health of the consumer and the willingness for them to not only spend what they have, but dip into savings if that's necessary.
What would you say about the health of these companies right now with regard to what their inventory positions are, what they're signaling around how they are being more nimble, especially around their product mix, given where consumers are taking some price in certain categories versus others where they're being, as Julie mentioned, more choiceful, as they were using that word with Walmart?
It's a great word. I think that what we've seen coming out of the fourth quarter pretty much across the board was very surprising. And, we started to get some indications of this as early as July from, some of the apparel and footwear retailers, just how aggressively they ordered for 4Q. And if you kind of go back into the retailer's mindset, many of them were short of inventory in holiday of 21. And so, they really did, overbuy, probably need a new demand forecasting system or really to rethink that, because what we saw kind of going into the back half of the year was very significant excess inventories. I think it's impressive across the board that they work through them as well as they have. And in many cases, right, we've even heard a word I hadn't heard in a decade, which was pack away. And that was putting away inventory for next holiday season because they had so much and they didn't really want to negatively impact either margins or top line.
Well, I'm glad you mentioned margins because I want to pick up on that. In general, how do you think that retailers are managing the margin question right now between they're still, in many cases, paying more for the stuff that they're buying, right? But their consumers don't want to pay more. So how are they managing that line?
Well, and as you also referred to earlier in the show, right, we're also seeing them raise wages. And so it is a very challenging balance right now. The positive is, as we see more of a movement towards own brand, which, consumers, the growth in private label has honestly exceeded all expectations. That is a much higher margin business. And so, we also have for multi-brand retailers like a Walmart and a Home Depot, right, this opportunity around retail media, which is just hits the bottom line. So I think they can, right? It is a bit of an interesting kind of, stew that they're brewing, but this idea that you can pay your hourly associates more, you can have more of your own brand, and you can be very aware and adjust in an inflationary environment. And you have this kind of gift with purchase, if you will, around retail media that can continue to drive your bottom line and really help your cash flows.
Do you think consumers are going to stick with store brands even if the economy gets better and continue then to benefit these retailers?
I think that what we saw during, kind of the height of the pandemic was a significant move into own brands. And that was really more kind of private label versus exclusive label. And that has not really retreated because I think there was this awareness, okay, I can actually keep my basket the same, slightly up in an inflationary environment if I am kind of, they always call it a trade down. I don't really think, in some cases the quality is just as high, if not higher. But, kind of traditional language would be you're trading down into private label. I think you're trading into maybe a product you haven't tried before. But I do think that the consumer is aware of that and then realizes that, they can eventually spend more. And as mentioned, we are seeing, still trips in positive territory and more units per visit, which would indicate that we are seeing they are looking at the overall basket price, putting in more private label, and then adding brands where there isn't a private label alternative, or, they feel that the brand is kind of more important to them at this point. And there is this kind of, I think, awareness by the consumer. And there's a lot going on as it relates to, the retailers driving awareness of those brands and the value.
These are retailers that have been able to scale up, the ones that we've been tracking this morning, Walmart, and of course the likes of Home Depot. That's meant that they have a larger employee headcount. That means that they have larger square footage that they operate. But for investors looking at how these companies would also weather a recession, which some have said is the most telegraphed recession in history, perhaps, when we hear the company allude to what that recession may look like, should investors still be more confident in the larger scaled up operations relative to the rest of retail?
I would tell you it's probably the most bullish I've been on retail because, of course, retailers sell products. But what we're starting to see now, going back to this kind of bottom line, is they're also now monetizing their data. They are they've got the whole kind of retail media play. And as you referenced earlier in the show, right, this kind of idea that they're building these platforms now for e-commerce, and that allows them to sell all kinds of things, goods and services. So yes, their core business, I think, will be challenged in 23. There's no doubt about that. And whether it's, kind of paying associates more, dealing with inflation and, let's just call it a volatile macro environment. But there are all these additional, and much of these kind of opportunities to monetize didn't exist a year ago. And that, I think, is something those are kind of really what to listen for this earnings season is what are the additional opportunities to drive revenues. We're hearing, right, Sam's Club is opening 30 stores over the next few years. They haven't talked about store growth in years. So there is this idea of really gaining market share right now. And I think that may be what you're focusing on is you are going to see these large multi-brand retailers continue to focus on the market share gains because they need the eyeballs to monetize. And that is a new game for them that they haven't played before. And they're finding, I would say, additional opportunities to do that, ways to do that. A lot of that is technology driven, but also just creativity. And we believe that we will see one of the best years when it comes to the bottom line for retailers in 23.
Just really quickly to follow on one aspect of that, are we going to see most retailers have to raise wages like Home Depot did today?
I think that we are going to see, there's still a challenge around having enough hourly associates. And we are continuing to see wages as a way to attract. Also, many of the other things that retailers are doing. But this is, if I were to list kind of some of the top concerns, having a, decreasing turnover in the workforce, being able to hire, so being a desired place to, be employed, and sustainability. These are things that these retailers are very focused on. And the reason sustainability is so important is it actually does attract hourly workers. So I would say that the ability to not only hire, retain, and train, and have these associates also kind of graduate into into management roles, et cetera. This is, supply chain, hourly workers, and sustainability are three of the top things on retailers' minds in terms of some of the challenges they face ahead. And then this opportunity around monetizing some of those eyeballs, that is where there is there is a lot ahead for them. But this is a challenging year, and retail is going to be volatile. And I think these management teams that are right now, I think being a little more cautious and conservative, I think it will serve them well through the year.
Take a look at Walmart's e-commerce growth. That sales segment, 17% up the fourth quarter compared to 8.3% growth for U.S. same-store comp sales as a whole. Interesting to see that breakdown, not necessarily following along the trends. But when you listen to their CFO this morning, two things come out in terms of you look at the big picture. When you zoom out a little bit, he says that the consumer is really pressured, and on the macro, they are very cautious, and that's why they're projecting not a great number for 23. But when you look at the share price come back, and is that bad news was absorbed? Not as bad as initially feared.
Yeah, not as bad. I think there's lots of questions out there about how exactly Walmart is going to handle the next couple of quarters, because yes, they are seeing their consumer be pressured. On the flip side, they are seeing higher prices from some of their suppliers. Procter & Gamble, Unilever, saying that they will continue raising prices this year, putting Walmart in a pretty tough spot because they have to decide whether or not they are going to pass that higher price along to the consumer. If not, then of course that would further pressure their margins here going forward. The trade down, though, is something that we started to notice going back to last year. Certainly seems like that has continued with grocery, that division being a short standout here for the last several months for Walmart. Grocery sales increasing in the low 20% basis on a 2-year basis. So take a look at that type of growth in the grocery division. More and more people are choosing Walmart as they are having to make those tough choices of where to spend and how to spend their money.
Yeah, it was interesting to see them increase their market share in grocery, in particular because the higher income households were beginning to trade down to Walmart. That, to me, above all else, was the most surprising thing from the report.
Retailers are betting big on the return of in-store shopping. Recent data out from Coresight research finding that major U.S. retailers opened more stores than they closed in 2022. Now, this is the first time that this has happened since 2016, the latest sign that the death of brick and mortar may have been greatly exaggerated. Let's talk about all this. We want to bring in Tom O'Hearn. He's the CEO of Macerich, which owns and operates shopping centers here throughout the country. Tom, it's great to have you. So certainly we talked a lot about maybe the death of brick and mortar, maybe the death of malls over the last several years. It certainly seems like that tide has shifted. What are you seeing? What are you hearing from your tenants today?
Well, you're right. The demise of the A-quality regional mall has been greatly exaggerated. And where we're really seeing it is in retailer demand. We're seeing demand like we have not seen since before the great financial crisis. 2022, for example, was a record year for us. We did over 1,000 leases, over 4 million square feet. It's a tremendous amount of retailer demand, and it's coming from a lot of interesting non-traditional categories. We're seeing co-working coming into the malls, multifamily residential, high-end fitness, new entertainment uses, office towers, electric vehicle makers are starting to take a fair amount of space in our malls. And it's not just Tesla. So the malls are becoming a place to be. They're exciting. And the consumer has certainly come back with a force.
Has the consumer come back, or have malls just evolved? Because we just spent 15 minutes talking about how consumers have shifted their spending from goods to services. Do malls actually reflect that trend?
Well, we do, because we provide things beyond just the traditional mall apparel and footwear uses. Today, it's a lot more food and beverage. Office components are part of it. Multifamily entertainment, for example, is a much bigger component than it was years ago. So it's bringing in more people, more energy. One example I can give you is we recently signed a deal with the Arte Museum, which is going to go in the third level of Santa Monica Place here in Southern California. They're going to take 48,000 square feet that used to be a theater. They're going to repurpose that space and basically create a digital art gallery, and they expect to bring in 1 million visitors per year. I mean, that's a tremendous amount of energy and traffic to the third level of a mall that, frankly, wasn't seeing that level of activity coming from the theater operator.
Tom, when it comes to consumers, obviously they're out there looking for experiences. Maybe that's why they're going out and shopping in person after shopping online for a while. But some of those macro concerns that we have heard about this earnings season, are you seeing any signs of that, just any signs of distress from any of your tenants in terms of people backing out of deals?
We have not. I mean, we've certainly been cautious about that and have an eye to that. We're sensitive that could happen given the macroeconomic situation that we find ourselves in. But the consumer has proven to be incredibly resilient. I mean, coming out of COVID, we expected that, but it's continued. And in fact, even January reported good, strong demand from consumers. So we're not seeing the retailers back off. We're not seeing the new uses back off. The leasing demand is still there. And, the proof is in the sales, and the sales numbers have been good. Like 2022, we were up 7%, and in January, we're up 3%.
Really fascinating trend, Tom, coming out of COVID when everyone, to your point, predicted the death. You mentioned something that caught our attention, and there was an article in the New York Times about people building upscale apartments at or near or actually in malls. Where are you seeing that? Do you think that accelerates?
I do think that accelerates. We're seeing it. In fact, we're doing it at Kierland Commons in Scottsdale. We're adding 110 luxury apartments to that project. And it's going to add not only the right kind of activity, it's going to add additional people. It makes it a more interesting site. And really what we're seeing is that A-quality regional malls are moving away from being malls per se, and they're becoming town center where people come to not just eat and shop, but also to live, in many cases to work. And it's going to continue to happen. At Flatiron Crossing in Broomfield, Colorado, we're planning a 330-unit luxury apartment complex. So we have more and more opportunities throughout our portfolio to repurpose former department store boxes and create multifamily and office, as well as hotels.